Welcome back. Today we're going to talk about the sixth cure to a lean purse, and that is our richest man of Babylon. Excuse me, our richest man of Babylon for your retirement and out your future income. Even if you are young, you tend to forget that someday, if all goes well, you're going to reach retirement. And a lot of people just don't plan for it. So the sooner you start thinking about what income are you going to live on when you retire, the better off you will be. Now, most of the things we're going to talk about again we're not part of the world of the great richest man in Babylon, but they are, in essence, the theme or the tools that we have to work with in the modern era. So that's what we are going to talk about here. Some of the things we're going to hit are the idea of investment real estate. In our last module, we talked about buying a house, a single family house. It has always kind of frustrated me, as having been kind of a real estate guy during my career, that when you ask people what is the best investment they ever made, they always tell you the house they live in. They bought it many years ago. It was cheap. It's appreciated in value. It's now paid off. It's the largest asset that most people have. Then my comment to them is, if one was good, why didn't you buy another one? Because you have to live in one. So it's not quite a real investment. And so if they had bought one to live in and then bought one to invest in, that always struck me as a good strategy. And that is what we would be talking about. And that did exist in the richest man in Babylon's era. Land was always a good investment. Real estate is almost always a good investment. So that is one part of most people's retirement plan, or at least it should be. And again, we'll talk more about that here in a minute. The idea of understanding, earlier we've done some compound interest calculations about how much you could have if you start saving early. Start doing some analysis of, if I set aside $500 a month for X amount of years at a certain interest rate, how much am I going to have to retire on? And then how much will that translate to in terms of living expenditures? What can I actually use to live on? Another element that we have in this time frame is life insurance. In the event something happens to you during your career and you die, you can actually leave an estate to your family through the tool of life insurance. And some calculation of how much life insurance you need would be a good idea. And again, a financial planner, that's what they're designed to help you with. Some of the retirement vehicles that you're going to have available to you when you retire is, number one, Social Security, pensions, 401ks, 403b if you're a public sector employee, individual retirement accounts, just stocks, bonds, mutual funds, gold, silver, real estate, and life insurance we've already mentioned. Annuities. Annuities are a mechanism for, if you accumulate an estate, you can guarantee that you can live on a monthly pension off that without ever having to worry that you're going to run out of money. They're a valuable planning tool. And finally, business ownership. If you build a business during your career and then you get to retirement and you can either sell the business and live on the proceeds, or you hire a manager to run it and you still receive the income from that business. A lot of wealth has been accumulated through ownership of businesses in the past. Now, some people kind of poo-poo when I talk about Social Security and pensions, as especially entrepreneurs. I find entrepreneurs are particularly snobby about, you people who have jobs, those jobs that pay a salary and things. They act like it's a dirty word. Well, Social Security averages $1,400 a month. And if you're married, that's 2,800, and your spouse also works. That's almost $3,000 a month total. But most people do not realize that if you have Social Security income of $1,400 a month, that's almost like having $1,000,000. That's a significant chunk of money. Because if you use 2% as an investment assumption, you would have to accumulate $840,000 in order to have a monthly income of $1,400 a month. Think of that. $840,000 to have an income of $1,400 a month with no risk that it's going to run out. It'll pay as long as you are alive. That's a significant chunk from a Social Security check. So that's a pretty impressive deal, I think. Now, it's similar for pensions. If a person makes $60,000 a year in their salary, they might easily have a pension of $30,000 a year from that $60,000 while they're working. That's just 50% of their final year average of their, typically like the average of the last 3 years or something like that. Well, if you had $30,000 and using that same 2% rate that you could theoretically invest in like a 5-year certificate of deposit, you would have to accumulate all over $1.5 million, or approximately $1.5 million to generate $30,000 a year. That's a lot of money. Now, that's a lot of money. That's what you as an entrepreneur, for you snobby entrepreneurs out there, you have to have set aside $1.5 million in an investment account during your working years. Not that you've made, not income, but set aside just for the purpose of retirement. That's what somebody who has this pension and a quote job actually has going for them. If they have the pension and Social Security, they're like a multimillionaire. And so you as an entrepreneur would have to generate that if you're going to go outside of the realm and not have a pension and not have a Social Security contribution. So don't make fun of people who have pensions and Social Security. Those jobs are very important, and I view them as significant investment vehicles. Now, we mentioned real estate, and we talked about maybe buying something other than just your residence. I'll give you just a quick, and again, this is not a real estate course, so I'm going to really zip through this pretty quickly, but I want to give you a flavor for this. Why real estate is a good investment. Real estate's a good investment because it has 5 things going for it. And now most other investments will only have 1 or 2 of these. So real estate tends to be better than most other investments. 1, it can generate income. This is rent minus expenses. That's cash flow. You can generate a monthly income from your real estate if you rent it out. Now, your house doesn't have this because you're living in it. That's why I said you'll maybe want to buy 2, because then you can live in one and rent the other out. And initially, you might only have a small cash flow, but eventually the house is paid for. And probably about the time you're ready to retire. And when you are ready to retire, now your income goes way up because you don't have to make the mortgage payments. And all of the rent coming in becomes cash flow to your retirement. And if you had 1 or 2 or 3, this can be a pretty significant amount of retirement money for you. Okay, the second reason real estate is cool is deductions. You get lots and lots of tax breaks from owning real estate. Anything that is in what's called an ordinary and necessary expense, which you can use your imagination a little bit to see what is an ordinary and necessary expense, is tax deductible. And a lot of the operational expenses that just kind of come with the investment are tax deductible. So that means they're cheaper than they would be if you were not in the real estate business. For example, interest and property taxes are tax deductible as well. So when you pay 5%, you're really not paying 5%. if you pay 2,000 property taxes. You're unlike if you're a renter, you don't get any tax break. And that's just the tip of the iceberg. There's lots of tax deductions related to real estate. Equity buildup is available if this is again not your primary residence. Your renters are paying off your loan for you every month, even if all you do is break even and didn't make an income. And even if you didn't take the tax deductions, at the end of this process, usually 15, 20, or 25, 30 years, you're going to own that building free and clear. And guess what? Those renters paid off your building, and you now can sell it and reap the money or rent it out. And like I said, just collect all the rents. Your cash flow significantly goes up. And third, appreciation. The idea that, well, buildings, real estate tends to go up in value. It's a function of supply and demand. As the population increases, demand for housing goes up. Now that's offset some by the supply of housing. As more people see that real estate is good, they build more housing. And if they build less than the demand, inflation, appreciation goes up. And so it's a function, your appreciation tends to be a function of population growth in your community and the rate of general kind of overall inflation. But both of those are significant, because if you bought that building for $100,000 at the end of 25 years or whatever the loan was, not only is your loan zero, so that would mean you have equity of $100,000, but that building is going to be worth a lot more than $100,000 20, 25, 30 years down the road. So the building might be worth $200,000. So your equity or your wealth is double what it was before, and you didn't pay for it yourself. It was paid off by the renters. That is really cool if you get it. And then the last thing is just as leverage. And I addressed this a little in the previous module. The idea you don't have to pay 100% cash on the dollar. You can borrow. You can put only 10% or put only 20% for a down payment, borrow the rest. This is really the insider's secret to getting rich. The idea of using other people's money for you to make your fortune. So that's a quick summary of why real estate is cool. Now, I'll give you a brief leverage example. If we take this assumption of the $100,000 rental house, we're going to assume it appreciates $10,000. If you invested $100,000, this is the example of not using leverage. If you put $100,000 into it, what is your rate of return, or what is your yield? That'd be 10,000 divided by 100, or 10%, which is still pretty good. That's actually a good investment. But now if you use leverage or other people's money, the right-hand side, same house, same appreciation. But this time, let's say you only put 10,000 of yours and borrowed 90. So you put 10 of yours, borrowed 90. Your rate of return is actually, you still make the appreciation in the top number, but you don't divide by 100. You always divide by what you actually invested, not what you paid for it, but what you invested. And you only invested 10,000. So effectively, you made 100% instead of 10. Now that's ignoring one kind of important thing. And the next slide, we will deal with that. That is ignoring, you actually, if you borrow money, the bank expects interest in return, and we're going to pay it. And we'll show you that example here. The real math is, we'll assume you borrowed the 90,000. So at 5% interest, you're going to have a cost of 4,500. So it appreciated by 10, but you actually had a cost of 4,500. So you actually only made 5,500, not the 10,000 in the previous slide. Everybody clear on that? Went up 10,000, you paid 4,500. Your net, what you have left, is 5,500. Quote, only 5,500. Still sounds pretty good. So, but your real rate of return was not really 100. That was overstating it. But it's also not 10. The real rate of return is 55% because it's 5,500 divided by your investment of $10,000. So that higher rate of return than 10% is because of leverage. That's what leverage does. So if you understand leverage in real estate, you can make an enormous amount of money. And that's why so many people have become so wealthy investing in real estate.